Welcome back. Today, we're looking at an analysis report, Forget the Noise, Why Analysts Rate MP a Strong Buy.
Yeah, the core argument is that government backing and a pivot to high-margin magnets justify an $80 price target, despite some recent volatility.
It's a compelling thesis, but a strong buy call needs to be bulletproof. So let's jump right in.
First up, bridging that gap between the massive CapEx spend and the promised return to profitability.
The report lays it out pretty cleanly. Net profitability is expected in 2026, and it's all driven by moving from low-margin mining,
which they peg at around 20%,
to much higher-margin magnet production in Texas, which should be coming online late 2025.
So the current net loss is just the cost of that future success. That's the story.
And that shift is really the linchpin of the whole argument.
It is, but the analysis report, it relies so heavily on that 2026 pivot without really digging into the execution risks.
I agree. It establishes the end result profitability, but it treats the ramp-up of this, highly complex Texas facility as a certainty.
And it's just not. I mean, when you're talking about hundreds of millions in CapEx, certainty is a luxury you rarely get.
That's where the sophistication gap really appears, I think.
Exactly. They're moving from mining rock to, hyper-technical rare earth magnet production. This isn't just flipping a switch.
No.
Commissioning a plant like this involves huge execution risks. You could have months of delays, unforeseen costs, or, and this is the big one, quality control issues.
Especially with partners like Apple or the DoD. They're not going to accept anything less than perfect.
And the report just kind of understates those hurdles. The very hurdles that institutional investors are worried about.
So to make this a true strong buy, we need to integrate a clearer picture of that production ramp-up. We need to build confidence in that 2026 timeline.
We need to replace projection with a path to execution. The analysis report should be addressing the milestones we need to see before the end of Q4 2025.
Okay, so how do we make that tangible?
Well, for a concrete example, the report could include a visual or even just a textual map of the production phase gates.
So not just they will produce magnets, but
detailing the transition from the initial pilot production all the way to the sustained commercial capacity they need to meet, say, that Apple partnership agreement. You show the path, not just the destination.
And on the numbers side, just saying significantly higher margin feels a little too qualitative for this kind of report.
Way too qualitative. You have to ground the numbers, quantify the margin expectations.
Give a range.
Yes, give a projected range. Let's say 45 to 55% gross margin. That would immediately anchor the entire profit calculation.
And that range is powerful because then an investor can do their own sensitivity analysis.
Right. What happens if the ramp-up is slow and they only hit 40% margin at first?
If the thesis still holds up, even at that low end, the strong buy becomes so much more resilient.
Exactly. Right now, it just feels like they plugged in a high number. Giving a substantiated, realistic range just immediately boosts the intellectual rigor of the whole thing.
Okay, let's move on. Let's talk about the second major pillar here, which is the geopolitical and government assurances.
And the report does a really good job highlighting how powerful these are.
It really leans on the U.S. government's involvement. They call it the Uncle Sam put.
Which includes the DoD investment and that Q1 2026 price floor.
And you couple that with the China hedge, the fact that MP is the only scaled non-China option out there. It's a powerful 1-2 punch.
It is. But while that price floor and national security angle provide tremendous support, the argument could be strengthened by exploring the specific conditions of those assurances.
I'm curious about that, though. I mean, isn't the mere existence of a DoD price floor the main thing? For a high-level report, maybe getting into specific contract terms is too far into the weeds?
That's a fair challenge. But I think in this case, the specificity is the rigor.
How so?
Presenting the price floor as this ironclad, capped downside risk without any context, well, it can lead to some dangerously simple assumptions about it.
So the weakness isn't the claim itself, but the lack of verifiable detail to back it up.
Exactly. Is that guaranteed minimum price a fixed dollar amount? Or is it indexed against inflation? Or maybe against MP's own cost of production?
And that distinction changes everything.
It determines the true quality of the safety net. If it's indexed to their costs, that's a fantastic shield. If it's just a fixed dollar amount, its real value erodes over time.
That's a crucial point. It adds a necessary layer of precision. And what about the time horizon? The report says the floor kicks in Q1 2026. For how long?
That's the other key detail, including the contract length, like the guaranteed floor is active for X years. That defines the time horizon. It's invaluable for anyone trying to value this company years out.
Okay, and let's touch on the China hedge. It kind of assumes the current geopolitical tensions are static.
And that's the second area where we need a bit more nuance. I mean, it's a low probability, sure, but a top-tier analysis has to consider the main counter-scenarios.
Like a sudden easing of trade friction?
Or China easing its export controls on finished magnets. Either of those could alter the market dynamics MP's capitalizing on right now.
So the suggestion isn't to argue against the China hedge?
No, not at all. It's to just briefly expand the risk matrix to include a scenario where tensions ease.
By doing that, you're showing you've done the homework.
Right. It shows you're presenting an intellectually robust thesis, not just a convenient one. It shows full spectrum awareness.
Which leads us perfectly into our final point, which is really about elevating the analytical rigor of the presentation itself. Specifically, how the report handles the noise.
Right. The opening section.
Yeah, it dismisses three big short-term concerns: the net loss, the insider selling, the stock drop, with these pretty standard qualitative counter-arguments. CapEx, diversification, a healthy pullback.
It's a classic rhetorical device, the noise versus the reality. But it can feel a little thin analytically.
You're using a qualitative shield against a quantitative sword.
That's a great way to put it, yeah. The rhetorical contrast, it inadvertently diminishes the report's analytical depth. It feels like a dismissal, not a refutation.
So you're saying a more sophisticated report should integrate that noise data directly into the reality pillars.
Absolutely. Don't just set it aside in a table. Take the Q3 net loss. Just saying it's CapEx leaves a huge analytical hole. How much was CapEx versus, say, operational cost overruns?
It's a question mark that doesn't need to be there.
And the same thing applies to the insider selling. That's psychological poison for retail investors.
Right.
So just saying it's for tax and diversification without context, it feels like an excuse. It doesn't feel like a verified conclusion from real due diligence.
So the suggestion is to shift from simple dismissal to analytical refutation. Use sharp data points to prove the noise is irrelevant.
Exactly. For the Q3 loss, get rid of the table. Integrate that discussion right into the 2026 profitability section. You could say, our analysis shows that X million, or 75% of the Q3 loss, was directly related to one-time commissioning costs.
And right there, you've turned a qualitative statement into a verifiable fact. What about the insider selling?
You have to give it a broader ownership context. You could state that the sales in question represent less than 1% of total executive float.
Ah, okay.
And then you contrast that with the huge DoD and institutional stakes that remain intact. It immediately diminishes the psychological impact of that news. It turns the rebuttal into something the reader can actually check.
And finally, that argument about the stock being down 18% being just a healthy pullback. That's a technical claim.
And it needs technical proof. Right now, it's just an assertion. You need to fold that argument into the valuation summary.
How so?
Compare the current RSI, the relative strength index, to the historical RSI after the last big rally.
So if you can show the current cooling-off period is in line with previous ones that came before another leg up,
then you've proven the technical health of the $54 entry point. You're not just asserting it based on a feeling. You're using the market's own history to support your conviction.
You know, this analysis report really has the makings of a truly exceptional investment case.
The foundation is absolutely there. The writer identified the critical catalysts, which is the hardest part.
The government backing, the tech pivot, the geopolitical scarcity.
Right. The core thesis is compelling.